This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, December 1st at about 8:25 Mountain Time. Our note this week was titled Putting Down the Regional Revolt. A couple of housekeeping items. We will release our annual 2026 Outlook note this Friday. We then leave for a trip to New York and Boston the following week, so there will not be a weekly the following week. We will release our annual Mac 5 or so macro themes for the next business cycle / decade on December 17th and our year in review note on December 24th. So a little bit of a change to our typical weekly publishing schedule through the holiday period as we get out our three annual notes. Be a great time to subscribe to Ironsides Macro so you can read all these reports that we love writing and put a lot of effort into this time of year. So the idea of putting down the regional revolt was from the point when New York Fed President Williams indicated a week ago Friday that he was on board with rate cut in December through the close on Friday, which marked the communications blackout for the Fed. We moved the probability of a rate cut from 40 and change percent up to 83% or so. So it's effectively a done deal at this point. There will, of course, be lots of questions about their outlook for 2026. But those need to be taken with a bit of a grain of salt, given that we're going to have a new Fed chair and President Trump, who says he knows who that is, but isn't going to tell us yet. We typically doesn't keep a secret all that long, so we think he'll tell us well before Christmas. But anyway, that's the outlook there. The market did not reject the idea of another rate cut or is not concerned about the inflationary aspects of that. The rally last week, as we started to price in a rate cut in tens, was from 4.15 in 10-year notes to 4%, with about 10 basis points of that being the inflation component. Inflation did not cause, or the Fed's rate policy did not cause the 2021 and 2022 inflation spike. Fed's balance sheet caused the spike in house prices and housing-related inflation and facilitated all the fiscal spending. So those are the real issues for the market, is government spending and the Fed's balance sheet, not the Fed's rate policy. A steepening of the yield curve will ultimately be a net positive for the supply side of the economy, and I think the markets know this all too well. So it did lead to a risk-on rally in cyclicals, and you saw things like small banks and transports and the most economically sensitive portions of the market rallied through that process last week. The data was very consistent with the Fed cutting as well. We finally got September retail sales, and although it was aged, it was negative. The daily Bloomberg transaction data has been negative, and although the anecdotes around Black Friday were positive, we think it'll be a pretty punk holiday selling season. The labor-related data that we received last week was also soft. We got some more of that this morning with the ISM manufacturing employment index going from 46, which is in contraction territory, down to deeper contraction at 44. So the outlook for employment continues to look quite soft. The PPI number, which again was a bit stale, was soft. And prices received in the regional Fed surveys for both manufacturing and services fell. Remember, in ISM manufacturing and ISM services, they only tell you about their input costs, prices paid. They don't tell you about the prices they're actually able to pass through to the public, prices received. We get that in the regional Fed surveys, and those have been going down since April, which is to our point that the conditions were not in place to be able to pass tariffs through to the public. They are indeed an adverse aggregate demand shock, as we discussed the previous week. The one bright spot in the data last week was capital spending plan 6 month forward from the regional Fed manufacturing survey. So that does keep alive the idea that the growth will pick up next year, driven by stronger capital spending in sectors that move beyond just building out AI infrastructure. We then went on to a discussion about the yield curve and how return on assets for regional banks and small and large banks are virtually the same, but the regional banks need a steeper yield curve to be able to grow their assets and open the credit channel. And we're going to see a broadening of all of that through the regulatory regime, which is going to effectively privatize the Fed's balance sheet. That'll allow the Fed to shrink their balance sheet and banks to hold more treasuries and make more loans. But that to us will ultimately be a good thing because it'll bring a degree of discipline into the financing of government spending. If government spends too much, banks won't buy treasuries, and that'll slow government spending, providing a bit of a private sector feedback loop to all that, as opposed to having the Fed just monetize the debt. So we will get the FOMC meeting in 10 days' time. Expectations will probably that it'll be reasonably hawkish in terms of dot plot and the outlook and all. The markets seasonally generally pretty soft at the beginning of December and will probably sell off a bit between now and the Fed meeting. But ultimately, the guidance doesn't matter all that much. What we really care about is the balance sheet and what they're going to do with the duration of the SOMA portfolio. Remember, duration tightening begins today with the reinvestment of mortgage-backed securities into Treasury bills, not into 5-year note treasuries or more mortgages. So final thoughts. We had a seasonal rally last week. We're probably going to have a little pullback this week. We'll probably get Santa rally, but we are more cautious going into next year. But for all the details on that, become a full subscriber and get our annual outlook note when it comes out next Saturday. Have a good week, everyone. Thank you.